Good afternoon, everyone, and thank you for joining us. And Z basically used a lot of the verbiage that I was going to use for the introduction, similar to your annual checkup, when you go to your doctor once a year or twice a year, or you do different things in your car every 3 or 4 months. Your finances need the same type of a checkup. So, uh, I'm Aureo Pinto. I'm an accountant, registered financial consultant, enrolled agent. I do accounting work, all phases of tax work, and all phases of financial planning. And as part of my financial planning practice, I have interactions with my clients different parts of the year, but usually mid-year is the most important part. Holidays have passed, tax season has passed, school is ended. People start looking at vacation, what they're going to be doing, or moving. Usually during the summer, that's when people start moving around, especially if the kids finished in one school and they have to move to another district. So a lot of things happen mid-year. And the first part of this year zoomed by very quickly. And before you know it, will be at the end of the year. So it's very important to look at what we've done so far in the first 6 months and where we're going for the next 6 months. So all right, so the 6 month checkup is, taking action with the 5 R's. And it's really 6 R's because I call this a mid-year refresh. So that's the sixth R. But I'll go through the 5 R's, which are reduce, renew, re-ask, review, and remember. And most of these are interrelated, but I'll go into each one and give you examples of the different things that we need to do in each of those. So the reduce is essentially reducing expenses. The economy is not getting any better over the last 6 months. The Federal Reserve has not reduced the interest rates. It doesn't look like they will for the rest of this year. There's a lot of things, a lot of moving pieces at this point. So the best thing to do is to go back to your budget. If you had a budget at the beginning of the year, review what your budget asked for. What were you budgeting yourself for? Where are you in that budget? So monitoring your spending is part of looking at where your first 6 months went. What did you spend on? What do you need to reduce? Did you have any extraneous expenses that you did not plan for? And then the actual cost cutting piece, which we always mention, cable and internet. Those are the ones that usually blow up out of proportion fairly quick. Sometimes they'll have a promotion. If you recently started with the cable company or with Verizon as part of your phone, you're also getting the cable piece. Their plans are usually like teaser plans. So you get a certain rate for the first year, for the first 2 years, then it'll go into their regular rate. That regular rate sometimes is double what you were paying. So is that happening to you? And sometimes the costs just go up. It's an organic increase. Every year or so, they'll increase a little bit here and there, or the taxes will go up. Any other fees that they charge will go up. It's a good thing to call them and see how you can renegotiate, change plans if you're not looking at all the, if you don't go through all the channels, if you don't use all the channels, you can reduce your plan and then just stream the particular channels that you use. And those are usually cost effective. We've done it uh, here. My family, we've cut down on one of the plans. We lowered the plan to the next lower plan, and then a lot of the other channels are just streaming, and it is a cost saving. So that's something to consider. Getting a break on your insurance rates, all kinds of insurance, homeowners, umbrella, car insurance. I just renewed my car insurance for the next 6 months. I use Geico, so every 6 months it gets renewed. Um, my policy just came in and it increased by, I think it was like $160 for the next 6 months. So it's an extra $30 a month. So I have to look at why it increased, and call them back and see, why did it increase? There were no claims. I had no accidents. We took that safety course that you take, and it's supposed to be a reduction in your insurance. So you always keep track of it. If you have your bills on auto pay, you might not notice that they're going up because you're just having them paid automatically. take a look at that as well. Go back into your account, to your bank account, or into your bills and see, am I still paying the same thing that I was paying? Because sometimes if you're on auto pay, you won't notice that difference until you're balancing your checkbook. If you balance it, or a couple of months later when you see that you're a little bit short, uh, more than what you expected to be, or you didn't expect to be short, and it's because of an increase that you didn't notice. Um, so yeah, car insurance, they're usually going up. Also look at, do you have a new car? Do you have a lease? Those you need to have full coverage. If you have an older car, you might not need full coverage anymore. You might just need the medical payments piece and the liability piece, and not the collision. So consider that as well. Look at how old the car is. If you have a note on it and you still owe it, you're going to need full coverage. But otherwise, if it's an older car and it's paid up, you might be able to reduce the coverage on it. And as part of reducing expenses, you also have to look at, your holiday spending. What do you want to do during the holidays at the end of this year? Look for sales now for things that you might be able to purchase now on sale instead of waiting closer to the holidays when stores will increase the prices because they know that people will be buying more. So that's one thing to consider as far as the reduction piece. It's kind of like looking at your budget, rebalancing what you have, and planning, reducing expenses, and still planning for the next 6 months. Any questions? If you have any questions, you can just chime in. You want to make this interactive. The next R is renewing your goals. So usually when you start with a budget or early in the year, you have goals. Like, I want to buy a car this year. I want to move to a different place, or I want to buy a new house, whatever the case may be. So look at your goals, renew your goals. Are they still goals that are viable? Are those still your goals? What you were thinking 6 months ago, are you still thinking that same way now? So do you want to continue those goals? If you do and you still haven't met them, then break them up into smaller goals. So when I said set smaller goals, I'm not saying like cut down on your goals. It's just break them up into smaller chunks so that you can save uh, differently, or if it's multi goals, like you wanted to go to like a long vacation, maybe take a smaller vacation or save in a different way for the vacation. So look at your goals, review your personal financial goals as well, and that goes back to what did you want to do in the beginning, what did you want to spend money on during the year, and look if you're check and see if you're on track with that. Review your emergency funds. Everyone should have an emergency funds. Every time we do one of these financial literacy chats, we always talk about emergency funds. Everyone should have at least 6 months. Some financial planners say 3, some say 6, some say 9 months. I go with 6 months. God forbid you would get sick and you can't work, or you lose your job, or you're moving to a different location and it's going to take you a while to get established. Have enough to cover 6 months of your living expenses. So review that. Do you have 6 months accumulated? If not, then go back to your first R and redo your budget. Look at what you're spending, reduce some expenses, and that money that you free up, put it into your emergency fund. It's very important to always have an emergency fund. Things do pop up when you least expect it. If you have a home, you know that you'll wind up with leaks, roof problems, plumbing problems, electrical issues. With your car, you'll wind up with tires needing to get replaced suddenly, your brakes or some other issue. So always have that little nest egg and monitor your spending. That goes back to your budget. Uh, Now look, if you didn't look at your budget during the first 6 months, now look at it very closely for the next 6 months. Look at what you're spending. Do you need to spend on that? Is there a way to reduce those expenses? And reevaluate your retirement accounts. That's something that should be ongoing, not only at the 6 month level, but things happen during the year. So you might have changed jobs. where now you might be getting more money, you might be earning more. So look at your retirement account. Can you put more into an IRA? Can you put more into a Roth IRA? Do you have a 401k at work where they match it so you can maximize and put away as much as you can? So look at your retirement account. Look at how much you need. There are calculators online will tell you this is the amount that you will need to retire. You input your current age, you input the amount of income that you have so far, or your savings in the retirement account. You input the age that you want to retire, and it'll tell you this is what you need. Every time I do that calculation for a client using my software, it winds up being at least $1 million. Looks like everybody will need at least $1 million to retire at the age of 65. So put away as much as you can, as early as you can. Start early. You'll be surprised that even if you put away a little bit, but it's early on, it does accumulate because you're using the power of compounding. So you'll wind up with that money continuing to build up very quickly. Then you have the re-ask. That's the third R.
Oh, I have a question.
Sure.
I wonder if you were talking about life insurance when you're talking about renegotiating.
Life insurance, it's not negotiable once it gets issued because the rates are based on your age when you get the policy, and it's an underwriting process. So they calculate your at your age what your life expectancy is and based on your health. So usually once a policy gets issued, it cannot be renegotiated.
Okay,
So
that's good.
yeah,
Thank
it's
you.
basically sure. It's basically homeowners, liability insurance, car insurance that you can negotiate because those are based on other items that don't have a life expectancy. So
Okay.
yeah, that was a good question. Very good. So
Oreo, someone asked about term versus full life insurance. Can you just explain a little bit about that and how it works?
sure, with term life, you're basically paying for the term that you're covering that policy for. So term life, you can get a 10-year policy, 15, 20, 25, or 30. So basically term life, you're covering it for a particular period of time, and you're only paying for the pure insurance. So as a result, term insurance is always cheaper than whole life. Whole life insurance, the policy, you can have it until you're 100 years old. And if you live to be 100, they return all the premiums at that point because they no longer cover you. But in the meantime, you're paying for insurance plus what they consider to be a savings component. And you have to be very careful with that and how it's sold. So whole life insurance is for a longer period of time, basically covers you for your whole life. The premiums are higher because you're paying for insurance plus an extra amount, and that extra amount, the companies take it and they invest it. And they tell you that you're going to wind up with a cash value. Then they'll tell you that you can borrow against that cash value without telling you that if you borrow against the cash value, when you pass, the loan has to be repaid, which reduces the face amount of your policy. They also sometimes don't explicitly explain that it's really not a savings component because if you were to pass and you have cash value, you will only get the face value of the policy. You will not get the face value plus the cash value. So they wind up keeping that cash value, which is the extra money that you paid. So in my company, and I've always done this, I always recommend term instead of whole life or variable or annuity life. There are different types of whole life under the whole life umbrella. I always recommend to use term life because with term, you wind up only paying for the pure cost of the insurance to cover for your life, nothing else. And if you wind up getting, let's say, $100,000 policy, term life, depending on your age, you might be able to pay $100 a month. Whereas a whole life policy for 100,000, your premiums might be 200 or even more. So that extra amount that you would pay on a whole life, you're really not getting anything out of it. What I tell my clients is buy term, and that difference that you would have paid, you should invest it yourself. So buy term and invest the difference. So that's the difference between both. Term life is just life insurance, pure life insurance for a particular period of time. Whole life costs you much more and it covers you for a longer period of time. The reason a lot of financial planners recommend term life is that if you're in your 20s and you get a 30-year policy or 35-year term life policy, by the time you're 50 or you're 55 and that policy expires, you shouldn't really need insurance because life insurance is basically covering your income to help your family if you pass. So when you're young, you have a mortgage, you have a family, you have kids, you should have insurance because if you pass, that money is needed to cover the income that you were bringing into the household so that the family can continue financially afloat. So that's why we always go with term. And people say, but it's only going to last me until like I'm 50 or 55 or 60. At that age, you shouldn't need life insurance because at that point, your mortgage is most likely paid or should be paid. Your kids are out of the house. And your income at that point, if you're already ready for retirement, you really don't need to protect your income. So that's the difference of the two insurances, why one's recommended over the other. If you have a lot of assets and you have a large estate, then whole life insurance is recommended. So there is a purpose for whole life insurance. Sole purpose in my practice and what I have seen in my discussions with other financial planners is that whole life is good if you have a large estate because the estate needs the life insurance policy in order to pay the estate taxes. So that way your heirs do not have to pay the estate taxes on what they're inheriting, and the estate basically pays for itself through that whole life policy. Other than that, term life is the best way to go. Any questions or any follow-ups on that? Anything else I should clarify? No? Okay. So I'll
I
go
would
through.
say that I've been wondering about that for a long time, so thank you.
Okay, no problem. If you have any other questions, just you can always bring them up, and I'll keep on clarifying because that's always a question that comes up, like what's the difference between term and life, term and whole life, and many companies will not explain the difference between both, and they will sell more of whole life than term life just because of that savings component, and a lot of people buy it because they're like, oh, I'm putting money aside and I could save, but you're really not saving because you're borrowing back your own money that you overpaid. So there is something to really consider when it comes to life insurance policy. Look at the different types of policies, look at how long you need the coverage for, and look at what type of income you want to cover. Like what is it that you want to protect? And that'll help you in guiding you whether it should be term or whole life. Okay, so in re-ask, and these are also similar to like the first couple of slides, but here you're looking at different things like, check your health benefits. Like sometimes middle of the year, a lot of companies will have what they call an open season, and you can check your insurance, your health insurance. You can switch to another plan if you think that you're going to need more coverage of a different kind that your insurance doesn't cover. Some insurance companies don't cover a lot of types of medications, some do. So that's something to also look at. Has your health changed in a way that you might need a different type of health insurance policy? And is it the proper time of the year for you to switch over from one plan to another? If you're retired and you have you have Medicare, or you have the Advantage plans, which I call the wraparound, because it basically covers your Medicare A, B, and D. That's also something to consider. Are you getting all your medicines covered? And things like that. A lot of the medications are coming off the payment schedules, which means that you have to pay higher deductibles and higher copays. So that's something to consider. Also anticipate your tax implications. What did you do in the beginning of the year that might impact your taxes when you start filing your taxes early next year? Did you sell any stocks during the year with capital gains that you have not basically made any tax payments for, or any estimated tax payments? Did you switch jobs and now you're earning more? Make sure that you're getting enough withheld so that at the end you don't have to pay a lot of taxes and you have enough taxes withheld as you're going along. That you sell any other kind of capital assets, that you sell your primary home for a large gain that you can't exclude, or only a portion of it is excludable. So things like that is also, you have to look at. If things like that did happen during the year, you should speak to your accountant, and you might need to do an estimated tax payment during the year to kind of pay a little bit up front, so that at the end of the year you don't have a big tax bill. And I mentioned this earlier, contribute to your 401k. Look at your 401k. Is there a match? Does your employer match it? A lot of employers match the first 3% or 4%. Are you maxing out? Are you putting in as much as you can so that you can get as much of the match as you can? Remember, for every match that you get, you made 100% return on the money that you put in. And that doesn't even include the earnings going forward. So go back to your 401k, look at your budget, and calculate if you can put an extra fixed dollar amount. They'll give you an option to put an extra $10, $20, whatever the amount is, or it's a percentage of your salary. So look and see if you can increase that. You want to increase your retirement funds as much as you can, as early as you can. So, and that's one of the easiest ways, especially with a 401k, where you get matches from your employer. If you don't have that type of a plan, then maximize your Roth IRA, or if you have a regular IRA. So the difference between a Roth and a regular IRA, the regular IRA, the money that you're putting away, is pre-tax. So depending on your income, you might be able to have a deduction on your tax return for the money that you're putting away. And it grows tax deferred. But when you retire and you start pulling money out of it after you're 59 and a half, you're going to pay taxes on a regular IRA. Whereas in a Roth, you're using after-tax dollars. So once you get your net pay, whatever's left over, if you put it into a Roth IRA, it's going to grow tax deferred as well. But then at the end, when you're retiring, you start pulling the money out from a Roth IRA, you do not have to pay taxes on it, because you essentially pay taxes on the money that you put in because it was already net pay. So that's one of the differences. And that's a very important difference. If you can maximize a Roth, you're better off, because later on when you retire, you might be at a higher tax bracket, believe it or not, or at your same tax bracket as when you were working. And your Roth IRA distributions will be tax-free. You do not have to pay taxes on them. Talking to myself and it was muted all of a sudden. Okay. And the last one is ask about employee benefits. Many times when you start a new job, they give you a stack of paperwork. You just sign off and you keep on signing, and you don't really read or know what it is that they're giving you. And a lot of those have to do with employee benefits. Go back to your HR, find out what type of employee benefits you can get. Many times what they do is a lot of companies have affinity programs, so you can get discounts. If you go to certain stores, you can get discounts. If they have purchasing power discounts with different organizations, or you get reduced tickets to certain events. A lot of companies have different types of benefits, like freebies. But most importantly, what other kind of employee benefits do they have? Most of them, if not all of them at this point, have to have health insurance benefits. So you have that. So look at the different options that you have with them. Some have life insurance as well. One thing to be mindful of is that life insurance from your employer is usually group term, which means that when you leave your job, you won't be able to take that policy with you, and you do not have that coverage. Some group term life insurances, you're able to convert it to your own policy when you leave, and then you just continue paying the premiums on your own. But for the most part, you don't have that option. So if that's one of the options that you have, you'll have the life insurance benefit while you're in the company, but always consider to have your own life insurance policy on the outside, because if you leave this job, you're not taking that policy with you. Any questions on this?
Can you check the chat, Oreo?
Yeah, let me see. Okay, term versus life, we did. Someone asked about pre-tax health spending, FHSA and FSA. Okay, so pre-tax health spending, that's a separate account that you set up through your employer. And what happens is the money that you put into that account is pre-tax. So if you put, let's say, $100 a month into an FSA account or a health spending account, that $100 will reduce your taxable income and you will not be paying taxes on it. So that's pre-tax. It goes into this health spending account. Once you go to the doctor and you spend and you get your bill back, whatever the insurance doesn't cover as far as a copay or co-insurance, you have to pay out of pocket. You can use that pre-tax health spending account to cover it. So that's one of the benefits, because now you're paying for a bill using pre-tax money that you didn't have to pay taxes on. So it was a benefit on the tax side, and now you're using it to pay down on your medical spending. And recently, they changed where you can actually use the FSAs as well for over-the-counter. So if you need to get any over-the-counter medications, like now allergy season, or any bandaging and things like that, you can use your FSA to pay for it. So that's a good benefit to have. And if that's one of the options, you should maximize and put as much as you can as well, because that helps you to cover out-of-pocket medical expenses. Okay, and next question is, can I get a Roth IRA from my bank? I have a finance guy, but I rarely deal with him. Yes, you can get a Roth IRA from a bank. You can get it from my financial planner. You can even get it online if you're affiliated with any credit unions. Usually credit unions will have Roth IRAs for their members, and that's something that you can even do online. You can set it up. And if they have investment options, depending on your age, consider putting it into a mutual fund instead of just putting it into a regular savings account, if you will, because with the regular savings or money market, you'll get like maybe 1 or 2%. But if you put the Roth IRA in a mutual fund, then you go fairly aggressive depending on your age and how much risk you want to take. You can make 3, 4, 5, 6% depending on what the market is, but you have to be willing to take that risk. But you can do it from a bank. You can do it from your financial person. You can do it from a credit union or online. Okay, those are the only questions that I see. Good questions. Okay, so
I have a question.
sure.
So I'm a teacher. So we do like TRS TDA. Do you suggest also doing the Roth IRA or maybe some other pathways for additional investing?
I would do a Roth IRA in addition to it. Do you have the option to put as part of your TDA into a Roth within the plan?
So. I think so. Yeah.
Okay.
I work for the city, so I think so. I'll have to check, but
Yeah, because now they're letting you do that as well as part of your normal retirement piece, so you can have a Roth. So if they give you that option, yes, I
Mhm.
would establish a Roth within that plan.
Okay, thank you.
For sure. And then there's the review. I mean, everything else in the first few slides was basically reviewing, but there's another level because now you're looking at your debt. So look at your credit report. You can get free copies of I believe you're able to get one per year or one every 6 months from the different credit houses, Equifax, Experian, or TransUnion. Get your credit report, look at it, see what kind of debt are being listed, see if there's anything that shows up as a gig because you're being gigged because you made a late payment, or there might be incorrect information and you can correct that. Look at your credit score. Score is very important if you want to go and get any type of loans or a mortgage. Credit score is now being used in addition to your income and your earning ability to come up with the interest rate that you'll be charged. So even though they don't really state it, based on their underwriting of a particular loan, you can wind up getting a favorable interest rate if you have a very good credit score. If you make payments on time, if your credit utilization is low. And what that means is, let's say you have multiple credit cards, and in total, your line of credit would be $40,000. If at any one point in time, um, an organization pulls that report to see what your credit score is, and you only owe 5,000, they're looking at the 5,000 as compared to the 40,000, and they're like, okay, out of 40,000 that you could be spending or in debt, you only have 5,000 in debt. They look at that favorably. If you have 30,000 in debt and your credit line's for 40, they're like, you're getting very close to your limit. You might be a credit risk because you're taking on now another loan and you're already very, very close to your current credit line. So you might not be able to make all these payments on time. So look at your total credit lines that are available, what you have so far on those credits that are on those credit cards that are charged, or loans as a charge, and you can get all that information from your credit report. And the lower your credit utilization is, the better it is. That adds to your credit score. Making timely payments adds to your credit score. Sometimes a lot of people will look at their credit report and they'll say, I have too many cards. Let me cut this one out. Be careful of the ones that you cut or that you close. The older accounts that you have are the ones that have given you the best rating usually, and that's the one that you have the best history for. And those are the ones that you should not cut. If you open up a card this year or last year, let's say, and now you're looking at it and you're like, no, I really didn't need that card. I'm going to cut it. That's fine. But if you're looking at for a card to cut, don't cut the ones that you've had for over 5, 10, or 15 years, because those are the ones that have continually reported. And usually the long-standing credit cards or loans in good standings are the ones that give you the best credit history. So keep that in mind when you're looking at your credit report, looking at your debt strategies, and looking at your credit score. And then there are different ways of paying down your debt. You can go through, paying the one that has the lowest balance outstanding. Some people like doing that because if you pay the one with the lowest balance first, once that's paid off, you're mentally in a good state because you're like, okay, I paid one down. Now I go to the next two. Some people like to pay down the ones that have the highest interest rates because those are the ones that continue to increase much quicker. So look at the strategy that you want to implement. Look at what you have available. And there are different methods of paying down your debt. Talk to your accountant, to your financial planner. There's the snowball effect. There's the sprinkle effect, or one of them you pay down the interest, the high interest first, or one of them you pay down, like I said, the lower balance first. So there's different methods, and we calculate each of the credit cards differently to tell you which ones would be better to pay first in order to lower your debt much quicker and lower the interest rates. But it all depends on your mental satisfaction. Like some people, even though they know that they should be paying down the one with the highest interest rate first, they like to pay the one with the lowest balance first because they like to check the box that I paid one down and I feel like I accomplished one full card out of the way. So it's just a conversation you need to have with your accountant or your financial person. All right, let me see. What about student loans? Yes, I'm going to go through student loans in a little bit. And yes, there's a snowball, there's an avalanche, and there's two other methods. One I think has to do with the snowflake, which is when you pay, I think the one with the lowest balance first. So there are different methods of calculating that pay down. So, okay, so let me go back up now and address the student loans. So student loans, there are different types of student loans. You have subsidized and unsubsidized. When it comes to subsidized student loans, it means that the interest will not accumulate while you're still in school. Unsubsidized student loans, the minute they issue you the loan, the interest will start clocking. So what a lot of people do in that instance is they'll start paying off as much as they can to lower the interest. So basically the payments that you're making are to lower the interest. If you default on your loans, that does impact your credit score because that gets reported. They will also garnish pay. They will garnish any tax refunds that you'll get from federal and from state. So student loans are kind of tricky, and they actually become more of a problem than credit cards, because with credit cards, you're able to sometimes negotiate a lower interest rate. You tell them, I'm going through a financial situation. I need a lower interest rate. Can you lower it so I can pay it down? Some cards will do that. Some cards will tell you that they'll lower it, but then they want you to cut the card afterwards. But it's easier to deal with a credit card than it is with student loans. So with student loans, be very careful on the amounts that are outstanding. That will impact your credit score to the point where you might not be able to get any other type of loans, including mortgages, if you have defaulted on student loans. I have a question. I use Chase Credit Journey. It's been good updating my score and telling me how to improve it. My credit available on my credit card has been making differences in my score. I only have one credit card. Okay, so you only have one credit card and your credit score has still fluctuated up and down?
Yes, that was a question.
Yes, I was asking that because you're saying the credit card available has been making differences, and I only have one card. So it's possible because you have probably gotten close to the credit limit, or you have been late on payments. Otherwise, your credit score should not move that much if you only have one card, unless you have other types of loans that are also impacting the credit score. So that's something to be mindful of. Look at the credit balance and the amount that's available, and kind of track and see if the credit card is the one that's making an impact on your score. It should not, for the most part.
Yeah, well, my score's been going up and down like 10 points or 30 points. And they say the reason is because of my I'm very close to my credit limit.
Okay. All right. That's why I mentioned that it might be that you're close to reaching that limit. Yeah, so that's going to be a big impact on the score then. But as you pay it down, as you continue to pay it down, the score should increase. What some people have done, and
Okay.
and and I don't really recommend it, but some people have done it and it has increased their score. But you have to be disciplined about doing it. Is some people have then called the banks and said, I have a kind of like a big purchase coming through. Can you increase my credit limit? And the bank will increase the credit limit for a certain period. That now creates a big gap between your credit limit and what you currently owe, which makes your credit score a little bit better. But if you do that, make sure that you don't go back up and start spending up to the new limit. Just start paying down, and that gap will get bigger, which makes the score better. So that's something to consider also, depending on how high your credit limit currently is.
That's good to know.
And the last piece here on this one is reviewing, considering your loan options. If you're going to buy a house, are you going to go for a variable rate, fixed rate? Right now, the rates are very high. Doesn't look like they'll come down over the next year or so. Sometimes a variable rate might be better as long as you have the option to convert to a fixed at a later point. So a variable rate, you might be able to get a better rate right now. It'll fluctuate, but the interest rates, I don't think they'll be going any higher than what they are. So that's one thing to consider. Also, do a variable rate, and then once the market starts coming down, you convert to a fixed rate or you refinance. So that's one option with loans. If you have any high interest rate loans right now or mortgages, wait until the rates start getting lower and favorable and refinance. And sometimes the cost of refinancing is worth it because you'll be saving a lot. Like right now, the interest rates are like 7 and change, close to 8. 3 years ago, they were down to 3.5, 4. So it'll make a big difference if it starts going back down to anywhere below 6. It's worth refinancing. And this is the last remember. The last R is basically you remember. It's a little bit of a hodgepodge. Insurance coverage and policy reviews. Look at your policies, car insurance, homeowners, umbrella. Look at what's covered. See if you really need to have that amount of coverage. Like I said earlier, if you have an older car or you've already paid off your car, do you really need to have full coverage on it? You can probably take off the collision or lower the collision and increase your deductible. That can make a difference also. The higher deductible you have on a car policy, the lower your rates will be, your premiums will be. So that's one thing to look at. And the next box, review your beneficiaries, kind of goes in tune with the following box. Be sure that your estate documents reflect your wishes. So reviewing your beneficiaries. During your lifetime, and there's a box down here, life changes, birth of a child, marriage, divorce, fluctuations in income. So there's life-changing events. Birth of a child, you get married, you get divorced, your income goes all over the place. That sometimes leads you to look at your estate, what you have, and looking at your beneficiaries. I have an example with us, with my family. My uncle passed away and he was divorced. And then after that, he never remarried. He had no kids. When he passed away, all his life insurance policies and all his benefits on his accounts, he had his parents, my grandparents, as beneficiaries. They had already passed. So his beneficiaries predeceased him. So my dad is the one who then had to go to court, and he got appointed to be the administrator of the estate, or the trustee. And he handled everything. And we had to prove to the court that his only beneficiaries were his parents. His parents had predeceased him, and the court had to now lay out who were the next of kins and who were the new beneficiaries, which turned out to be all his siblings. So look at that. Look at your beneficiaries once a year at least. If you have a birth of a child, your beneficiaries can change. Your child can be a contingent. If you have a marriage or a divorce, your spouse now becomes a beneficiary, or move them out of being a beneficiary, depending on how that relationship is. So that's something to always look at, because later on, the family has to figure out all the paperwork and who is the beneficiary or who should be the beneficiaries, and the court needs to get involved, and they're the ones that make that decision. So that's something that it's always one of those once a year or twice a year refreshes where you look at all your paperwork, make sure they're up to date. If you have a joint bank account with somebody, see if that beneficiary or that joint owner should still be on your account. Make sure that your estate documents reflect your wishes. That's another very important one. A lot of people will state, when I pass, I want this to be done this way, or I want to be cremated, or I want to be buried. I want to be buried in this particular place. If it's not in writing, it usually causes issues later, because family will always disagree on he said it, he didn't say it. Always have things in writing. Have an instruction letter handy where it says where it'll state where all of your other documents are, and also rehashes what your final wishes are. That's important. A lot of people pass, their family comes in and they try to get the paperwork. They can't find life insurance policies. They can't find wills. They can't find anything. They're scrambling, trying to get as much information as they can. So have an instruction letter, have a particular area where you have all your documents in a safe place, and point everybody to that direction. Review your credit card benefits and reward offers. So before I was talking about, credit cards as far as limits and credit scores, but a lot of credit cards also offer a lot of rewards. You either get points on mileage for travel, or you get cash back that you can use for anything else. If you take advantage of that, only do that when you're able to pay the bill at the end of the month. Don't charge things to a credit card to get mileage for a trip, and then if you're not able to pay off the credit card timely, you're going to wind up paying interest, or if you're late, you're going to wind up paying a penalty, and that kind of washes away the benefit of getting these other miles or these other points. So use it strategically, and if you can pay off the bill and you have the cash, but you're like, if I use the credit card and then I pay it off, I'll get this other thing, which will be cash back or miles. I will do it that way. So look at those benefits and how you can do that. Research deals for summer travel. That goes hand in hand with that. Look at what's going on now. Where if you're planning a vacation, where can you go, and do you have miles accumulated or anything else as a benefit that you received? Take advantage of that now. Search products that are on sale now at discount, especially for the holidays. During the summer, you might be able to buy things and stash it away for gifts later on. That goes with the planning for the holidays. Start planning for the holidays now. If you have an idea of what you want to do, what you need to buy, and you see it on sale now, buy it now and put it away. During the holidays, prices always go up. Stores will always increase their prices, and then they'll give you a sale. So you think you're getting it for less, but you're basically getting it for the same amount that you would have gotten it a couple of months before. So you're able to get now things at a better price than you would later on, even with the sales. Are you moving? I said earlier, a lot of people during the summer move, kids change schools, or you start a different job, or you just want to move out and go somewhere else. So also plan for that. Make sure you have enough money for it, and keep those expenses as low as you can. Life changes I went through earlier, that goes hand in hand with your beneficiaries. But one other thing to look at, life changes, birth of a child, always go back to your employer. Add your child to your health insurance so that they are covered. If you get married, add your spouse to the health insurance. If you get divorced, same thing. They have to be taken off the policy. And then the last one has to do with the loans. I kind of talked about that earlier. The problem with student loans is the type of loans that are offered, whether they're subsidized or not. So usually when you're doing undergraduate work, there's a certain amount of loans that you can get that are subsidized. So you do not have to pay the interest rates on those, and the interest rate does not start getting calculated until after you graduate. If you have a unsubsidized loan, the minute they disperse the loan, the interest rate starts clocking and you start owing on the interest. If you're still working or you're having difficulties getting a job, or you're still in school, ask for a deferment. Always let the Department of Education or the school or the bank that's handling your student loans know your financial situation. Ask for a deferment when you need it. Ask for postponement of interest rate if you can. Sometimes you can consolidate student loans as well. So that's something to consider depending on how many you have and the type of loans that you have. So always remember that. Any questions? Anything? We're toward the end. That's my contact information. Phone number, email address. Any questions, reach out to me. Any questions now, we can address them.